So thanks to our previous speakers, and we appreciate their support. Our next topic is going to be on the unequal consequences, economic consequences of carbon pricing. And the author is Diego Kaenzig. Diego is a PhD candidate at the London School of Economics. And this paper at last year's, or this year's, I guess, ECB Forum was awarded the Young Economist Prize. As a result, Diego has participated in the job market, and he is going to Northwestern to be first a college fellow and an assistant professor next year. To discuss the paper, we have our own Johannes Stroebel. Johannes is the David Loeb Professor of Finance at NYU Stern, and he is our faculty coordinator for climate risk in the Volatility and Risk Institute. So Diego, without any further ado, please take the floor.
Fantastic. Thanks so much for the kind introduction, Dick. Also, many thanks for organizing this fantastic conference and for including my paper. I'm very excited to be here today to talk about the unequal economic consequences of carbon pricing. I do think the topic doesn't require much motivation, especially at this venue. And this morning, we have already discussed extensively that there is broad consensus that climate action is urgently needed. Carbon pricing policies are increasingly used as a tool to mitigate climate change all over the world. However, because these policies haven't been in place for that long, still relatively little is known about their effects on emissions and the economy in practice. Is carbon pricing effective at reducing emissions? What is the impact on output, employment, and inflation? And most importantly, who bears the economic cost of these policies? I think these questions are particularly relevant against the recent surge in electricity and gas prices, which has been further exacerbated by the tragic war in the Ukraine and growing concern about energy poverty, especially in Europe more broadly. In this paper, I present new evidence on these questions from the European Emissions Trading System, short ETS, which is the largest carbon market in the world. I will exploit institutional features of this market in combination with high-frequency financial data to estimate the aggregate and distributional consequences of carbon pricing. The EU ETS is a cap-and-trade system, so unlike a carbon tax where you regulate the price, the quantity is regulated. So there exists an overall cap on emissions covered by the system, and within this cap, allowances are allocated and then traded. Therefore, there exists a market price for carbon, and importantly, there also exists liquid futures markets. Now, establishing the ETS was a process, and the regulations in this market have changed considerably over time. And it is exactly these two observations that motivate my identification design. And the idea is to isolate some exogenous variation in the carbon price by measuring how carbon futures prices change in a tight window around regulatory policy events concerning the supply of emission allowances in this market. And in the next step, I use this variation as an instrument to estimate the dynamic causal effects of a structural carbon policy shock. Let me give you a quick preview of my results. I find that carbon pricing has significant effects on both emissions and the economy. A shock tightening the carbon pricing regime leads to a significant increase in energy prices, a persistent fall in emissions, and an uptick in green innovation. So this is the positive. The policy appears to work. However, this doesn't come without a cost. I also document that economic activity falls, at least temporarily, and consumer prices increase actually quite persistently. And importantly, these costs are not borne equally across society. Using detailed household level data, I find that poorer households lower their consumption significantly and persistently, while richer households are much less affected. And it turns out that not only are the poor more exposed because of their higher energy expenditure share, this is one of the standard channels that people have in mind, I also find that they face a stronger fall in their incomes. And these indirect effects via income and employment turn out to play a crucial role in the transmission of the policy. In fact, my findings suggest that they can account for up to 80% of the aggregate effect on consumption. And finally, I also developed a climate economy model that features heterogeneity in energy expenditure shares, income incidence, and marginal propensities to consume. And I show that a model with these ingredients is able to account for the empirical facts that I document And in this model, I can also show that by redistributing some of the carbon revenues to the most affected households, one can reduce the economic cost of the policy and obviously mitigate the inequality impacts without compromising emission reductions to a significant extent. All right, after this brief introduction, let's jump right into the paper. And let me start by giving you some more information about the institutional details. So I'm going to use exploit institutional features of the European carbon market. So this market was established in 2005 and covers around 40% of overall EU greenhouse gas emissions. Again, it is a cap and trade system. So there is a cap on total emissions covered by the system. And to ensure that emissions fall over time, this cap is reduced each year. Within this cap, emission allowances short EUA are allocated, and there are different means for doing so. In particular, during the first years of the system, basically all these allowances were allocated for free, but later on auctioning became the default way of allocating these allowances, and currently more than half of all the allowances are actually auctioned off. At the end of each year, the companies covered by the system must surrender sufficient allowances to cover their yearly emissions. And this is actually enforced with quite heavy fines. So compliance in this market is very high. And these allowances are traded on secondary markets. And again, there exist both spot and futures markets for doing so, but most of the action really takes place in these futures markets that I'm also going to exploit. Now, establishing the EU ETS did not happen overnight. It was more of a learning by doing process. The system was established in 3 main phases, but even within these phases, the rules have been updated continuously, for instance, to address issues encountered in the market, to expand the coverage of the system, or to improve market efficiency. So there are lots of regulatory events in this framework. In this chart, you can see the evolution of the carbon price over the 3 phases that I'm going to consider in this paper. And what I want you to take away from this chart is that there was quite a bit of variation in this price. And this is exactly what I'm going to exploit for identification. In the next step, I collected a comprehensive list of regulatory update events. These can take the form of a decision of the European Commission, a vote of the European Parliament, or a judgment of a European court. Of key interest in this paper are regulatory news concerning the supply of emission allowances. So there were a number of events that actually changed the overall cap or the rate at which the cap is reduced, but obviously these are relatively few. So I also consider a lot of events concerning the free allocation of allowances. For instance, during the first years of the system, the countries covered by the system had to submit national allocation plans to the Commission, and the Commission had to approve them. So there are lots of events regarding these allocation plans. Later on, when auctioning became the default way of allocating these allowances, there are lots of events regarding the timing and quantities to be auctioned. So going through the official journal of the European Union, I was able to identify 113 relevant events during the period from 2008 to 2018. Based on these events, the idea is then to identify a series of carbon policy surprises by measuring the price change in a tight window around the regulatory policy events. So to fix ideas, these carbon policy surprises are constructed as the percentage change in the settlement price of the EUA front contract on the event day and the last trading day before the event. In this chart, you can see the resulting carbon policy surprise years, and we can immediately see that some of these events led to quite massive changes in carbon prices. For instance, in 2014, the European Parliament voted against the Commission's backloading proposal, and this sent carbon prices down in excess of 40%. So to give a bit of context, this was related to the fact that after the global financial crisis, emissions fell by a lot in Europe because of the subsequent recession. But this was not taken into account in the way the caps were set. So over time, an oversupply of emission allowances accumulated, and the Commission wanted to address this by backloading, by postponing the auctioning of new allowances. But in the first instance, this was rejected by the European Parliament, sending prices down excessively. But there were also a number of other events that led to quite massive price changes. But let me emphasize here that my identification strategy doesn't really hinge upon these large events. If I exclude them, I just lose a bit of precision, but the point estimates are very similar. Also perform a number of other diagnostic checks. It turns out that this series accords well with the narrative account of some of these key historical episodes. Also find no evidence that the series is serially correlated or forecastable by past macroeconomic or financial indicators. So I hope I could convince you that this carbon policy surprise series has some nice properties, but I will still argue that it is only an imperfect shock measure. Therefore, I won't use it as a direct shock measure, but I will use it as an instrument to estimate the dynamic causal effects on the variables of interest. So basically the idea here is if you have a measure that is correlated with the shock that you want to identify, in our case, this would be the carbon policy shock, but uncorrelated with all other shocks. So this could be monetary policy shocks, fiscal policy shocks, oil shocks, just to give you a couple of examples. Then we can actually identify these impulse responses on these variables of interest. For estimation, I rely on VRI techniques, given the relatively short sample, but my results are robust to using different approaches as well. All right, now we can move to the fun part and I can show you some results. But before we go there, as in any instrumental variable analysis, we have to look at the first stage first. To this end, I perform a weak instrument test. The corresponding F statistic is around 21. And this is high enough to rule out weak instrument problems with a reasonably high confidence. In this chart, you can see the impulse responses to a carbon policy shock normalized to increase the energy component of the harmonized consumer price index by 1% on impact. So we can see that the shock tightening the carbon pricing regime leads to a significant increase in energy prices and a persistent fall in greenhouse gas emissions. Thus, the policy turns out to be successful in its goal of reducing emissions. Let me also mention here that this is overall greenhouse gas emissions, not only the ones covered by the EU ETS. So this is not a mechanical decrease here. However, this has also consequence for the economy more broadly. So consumer prices also increase significantly, and the pass-through from energy to headline is around 15% at its peak. Industrial production falls, at least temporarily, and the unemployment rate rises. But interestingly, it turns out that the fall in emissions is much more persistent than the fall in activity, implying that the emissions intensity actually improves in the longer term. And I have some additional evidence on this, which I won't be able to show you today when I look at the effects on green innovation, where I find a significant uptick in the patenting activity in climate change mitigation technologies after this shock. Monetary policy appears to largely look through the inflationary pressures of this shock. The stock market takes a dip, but then recovers relatively quickly. So overall, these results illustrate that there is a trade-off between reducing emissions today and thus the future costs of climate change and the costs in terms of lower economic activity today. The results also suggest that energy prices seem to play an important role in the transmission of the policy, and this suggests that the power sector is able to largely pass through the emissions cost to energy prices. This is not a new finding, this has been established in the literature before. However, energy price in turn can have significant effects on the economy via both direct channels, for instance, by affecting households and firms' disposable income, or indirect channels via the general equilibrium effects on wages and employment, for instance. So to get a better understanding of these different channels, it's also instructive to look at the effects of the shock on GDP and its components. And this is what you can see in these charts. So we can see that GDP also falls significantly after the shock. And if we look at the components, we can see that this is driven by a fall in consumption and investment. And the consumption response turns out to be particularly pronounced. Regarding the magnitudes, again, this is a shock normalized to increase energy prices by 1% on impact, but the consumption response falls by about 0.5% at its peak. And this is much larger than what can be accounted for by the direct channel via energy prices alone, which is theoretically bounded if energy demand is completely inelastic by the energy share of the economy, which is around 5 to 7% in Europe. So this is by a magnitude larger than that, suggesting that these indirect effects, these general equilibrium effects, may play an important role. And to get a better understanding of the relative importance of these channels, it is helpful to study also the heterogeneous effects of carbon pricing, with a focus here on households, also because the consumption response was particularly significant, and the consumption is the largest component of aggregate demand, so it's useful to look at that first. The challenge here is that there is no household level microdata available at the EU level for a long enough and regular sample. Therefore, for this part, I focus on the UK, but if you're concerned about external validity, I also confirm my main results for Denmark and Spain. So this seems to be a broader phenomenon than just for the UK. I use data from the Living Costs and Food Survey. This is the main UK survey on household spending. It is a repeated cross-section. It doesn't have a panel dimension. So to estimate the dynamic effects of the policy, I use a grouping estimator. So I group households using their normal disposable income, which is a proxy for their lifetime income, into 3 groups: low income, middle income, and high income households. Here we can see some descriptive statistics on these households. And what I want you to take away from this are the statistics regarding the energy expenditure share, which is around 7% on average for low-income households. It is close to 10%, whereas for high-income households, it's only about 5%. So the energy share of low-income households is almost double the energy share of high-income households. In this chart, you can see the responses of household expenditure and income for the 3 income groups that we consider. So we can see that low-income households lower their consumption significantly and persistently. On the other hand, higher income households display a more muted response, and the response is also much less persistent. And it turns out that not only are these low-income households more affected because of their higher energy expenditure share, as we just saw, if we look at the response of household incomes, we can see that also low-income households face a more substantial and significant fall in their income. So these indirect effects seem to play an important role. What is the relative importance of these two? To gauge that, it is instructive to look at the cumulative change over the impulse horizon in pound. So these numbers here can be interpreted as the overall pound adjustment in quarterly expenditure and income over the 4-year impulse horizon. So we can see that energy expenditure increases across the board. In relative terms, it decreases the most for low-income households, consistent with the fact that these households have a higher energy expenditure share. But importantly, these increase in energy expenditure can in no way account for the much more substantial fall in non-energy expenditure, particularly for low-income households. And these households also face a significant fall in their income. Now, I can't establish a causal relationship between income and expenditure because I don't have exogenous variation in income, but it is still interesting to observe that the magnitude of the fall in income for these low-income households is more or less of the same order than the magnitude of the fall in their expenditure, which is consistent with the interpretation that these households are more financially constrained, have a higher MPC, and thus have to adjust their expenditure by much more faced with the adverse effects on their income. The situation is quite different for higher income households who also face a non-negligible fall in their incomes, even though in relative terms, relative to their average incomes, it's more muted. But importantly, their expenditure adjustment turned out to be much more muted. And this is also consistent with the interpretation that these households are less likely to be financially constrained and better able to cope with the adverse effects on their earnings and income. Overall, if you look at the overall numbers, it turns out that these direct effects by energy prices can only account for about 20% of the fall in expenditure, whereas these indirect effects via income really account for the bulk. And this is also important when we want to gauge the distributive effects of the policies, because the existing literature has often found that these policies are only mildly regressive, if at all, but these studies typically focus on the direct price impacts of the policy. I show that when we also account for these indirect general equilibrium effects, policy can become much more regressive. Based on my estimates, I find that low-income households account for about 40% of the aggregate effect on consumption, even though they account for a much smaller share of consumption in normal times, which is only around 15%. Now, another interesting question is what drives the heterogeneity in these income responses? And to analyze that, I have looked at how the income response varies by the sector of employment. Interestingly, it turns out that sectors with a very high energy intensity didn't really display a significantly different response from sectors with a lower energy intensity. which is a bit counterintuitive if you think of this as a cost push shock. So we would expect that industries with a higher cost share of energy are relatively more affected, but this does not seem to be quantitatively that important. The sectors where I found the strongest response of incomes are so-called demand-sensitive sectors. So these are sectors that produce more discretionary goods and services, such as retail, hospitality, or other types of private services. And these are also the sectors where low-income households disproportionately work, while they're actually underrepresented in sectors with a very high energy intensity. So this can also explain this heterogeneity in the income responses. And this has important policy implications as well. My results suggest that fiscal policies targeted to the most affected households can reduce the economic costs of climate change mitigation policy. To the extent that energy demand is inelastic, this shouldn't compromise emission reductions, and these very low income households also only account for a rather small share of aggregate emissions. And also, what is interesting in defining the most affected households, maybe if we just look at the energy expenditure share, this may be too short-sighted. I show that these indirect effects also are an important role. So maybe we should not only be worried about coal workers in the US, but also about people that work in Walmart or just live on a very tight budget and are more exposed to these kind of policy changes. I think this is especially relevant, especially given the recent surge in European carbon prices. In the current EU ETS, there is no direct redistribution scheme in place that could offset these distributional effects that I document here. And as we all know, in a democracy, we need public support to be able to manage to achieve the transition to a low carbon economy. So I think it's important for policymakers to be aware of this and think about how we can take this into account. All right, this is basically it from my side. Let me conclude. In this paper, I present new evidence on the economic effects of carbon pricing from the European carbon market. I've shown that the policy is successful in reducing emissions. However, this comes at an economic cost, which is borne quite unequally across society, particularly when we also account for these indirect effects via income and employment. The policy turns out to be quite regressive. But on the upside, we have the tools to address it. Targeted fiscal policies are able to reduce these costs without compromising emission reductions to a significant extent. Thanks so much.
Thank you, Diego. And Johannes, the floor is yours for discussion.
Perfect. Thank you very much. This is a really fun and important paper, and as Diego knows, I'm a big fan of it. I come to this paper from sort of a pretty basic economic observation, which is that when we teach first-year undergraduates about the concept of an externality, climate change really is the poster child of what we mean by an externality, right? So I don't take into account, when I decide how much to drive, for example, the negative effects that behavior has on other people through the carbon emissions from me driving around. Now, in economic theory, we have a pretty simple solution to these types of externalities, simple at least in theory, which is that you want what we call Pigouvian taxation, right? So, and a carbon tax is really just an example of a Pigouvian taxation. So you'll put up a tax up to the point such that the private marginal cost combined with the tax equals to the social marginal cost, and then you would get carbon emissions at the socially optimal level. And in many ways, this is one of the least controversial ideas in economics. In fact, Bob Litterman, who is on the VRI board, was putting together an advisory commission to the Commodities and Futures Trading Commission, and sort of the most important recommendation from that commission, which by the way was endorsed by a huge range of institutions, anywhere from BP, Chevron, banks, asset managers, academics, et cetera, start out saying, look, the most fundamental finding of our reports is that financial markets and the economy more broadly will only be able to channel resources efficiently if we have a price on carbon in place. Despite sort of this, what you would think almost unanimous agreement by economists that carbon taxes are the exact right way to deal with climate change as an externality, these carbon taxes appear to struggle to get any traction in the US, and their traction in other parts around the world is sort of limited. So the Atlantic last summer wrote an obituary on the carbon tax. It says, beloved by policy to fix climate change is dead at 47. For some reason, we're not getting carbon taxes any sort of political momentum within the US. And from an economist perspective, it just leaves you with the question, what is there possibly to dislike? It has all of these phenomenal efficiency benefits. What are the things that you might not like about it? And so here's one of the things where I find Diego's paper to come in, which really it offers one possible explanation, one thing that you might not like about carbon taxes, which is in addition to these efficiency gains that you have, carbon taxes have these very, very strong distributional implications. Now, I just want to briefly mention, it's obviously not the only possible problem with the carbon tax, right? So you worry about relative competitiveness if you don't have well-working border adjustment taxes, etc. So there's other implementation issues, but one really important part is that these carbon taxes might have important distributional implications. And really what I've used Diego's paper to do is to highlight this point in a very salient way, using sort of a clever combination of both, data combined with sort of, heterogeneous agent models that allow sort of these distributional effects to be captured very effectively. There's two mechanisms in this model. The first one is that, the direct effect, carbon pricing leads to higher energy prices. In some sense, that's the exact point that they should have. This is not a byproduct. This is the exact point. You want to increase the price of gasoline up to the point where it incorporates the negative externalities that driving has on other people. So again, that's a feature, not a bug of a carbon tax. But that can have a direct distributional implication, which is that, as he showed before, poor have a higher energy share in consumption, prices of energy go up, the cost of the fixed consumption bundle, in the absence of any substitution away, will be higher for poor people rather than rich people. As Diego shows, that effect is there, but overall energy sharing consumption isn't big enough anywhere for that to have a very large effect. And so one of the things this paper does very nicely is to have a second effect, which is that higher energy prices will reduce economic activity, that will reduce income, etc. And if the reduction in incomes is also unequal across society, you're going to get a second mechanism through which you're going to get distributional implications. So you might, for example, get, and as he gets in this model, that the incomes of the poor fall more than the incomes of the rich as a result of the second general equilibrium knock-on effects from higher energy prices. Now, quantitatively, in terms of aggregate effects, this second channel is 4/5 of the overall aggregate decline that he gets in his overall model. So it's really, really important to not just say, well, the energy share and consumption isn't very high, so the effects of carbon taxes can't be very big, but that you take these knock-on effects into account, and then also the distributional implications from these knock-on effects. Overall, my high-level thoughts on this, again, I think it's a really great paper, and I think the mechanism is very plausible. I think the one thing where I'd like to see a little bit more is more guidance on to help me think through the magnitudes. I want to kind of give you an example of what I mean by this. So in terms of the magnitudes that Diego gets from these VRI exercises, the shock that we're looking at is a shock in carbon prices that leads to a 1% increase in energy prices. And these are sort of graphs that he showed in his presentation too. And so then the question is, what are sort of the economic magnitudes of the effects we get out of a shock that leads to a 1% increase in energy prices? And so what you saw is that, that shock in the data, using this VAR technology gets you a 1% decline in industrial production, that, fairly persistent, and, an even more persistent 0.2 percentage point increase in the unemployment rate. And in many ways, when you see these numbers, you think those are extremely large, right? Those are phenomenally large numbers. Why? Well, think about it. Carbon taxes aren't the only thing that are moving energy prices around. In fact, energy prices are extremely volatile. So if you look at the oil price, right, it's gone up by a factor of 5, over a period of, of a year or so. And, if every percentage point increase in energy would lead to a 0.2 percentage point increase in the unemployment rate, then a doubling or tripling of energy prices would imply a complete and utter tanking of the economy. So the magnitudes that come out of these exercises where a 1%, the carbon tax that has the scaled to be large enough to lead to a 1% increase in the energy prices leads to these very, very large declines. I think just needs to, I need a bit more help to make sense of that. There's a bunch of mechanisms that could be going on. It could be the duration of the shock, right? So it could be a permanent versus a temporary effect. It could be that there are non-linearity. So it could be a small increase in energy prices has a larger effect than a large increase does. Though most models would actually give you the opposite, right? It would give you smaller effects for small changes, and then at some point, substitutability becomes harder and harder, and you would expect it to be there. But just help me make sense more quantitatively of how to align a 1% increase in energy prices with a 1% decline in industrial production. I know you're getting this, and then in your model yourself, you need all these other knock-on effects to somehow generate that in a model. before I'm starting to figure out how to generate that in a model, I want sort of more help with how, making sense there relative to just, the fact that when energy prices move around a lot due to other shocks, we're seeing nowhere near as large, shifts around in various aspects of economic activity. With that sort of small quantitative point aside, I still think that it's really, really key to focus on these distributional implications of carbon taxes. And I think directionally, figuring out who's more or less affected, I think this is exactly right. And it really highlights this sort of central point that we need to use fiscal redistributive tools that we have to offset those distributional implications if we're going to get sort of strong, social consensus that those are the types of policies we should have. Now, where should this money for redistribution come from? Well, I think the reason the redistribution should come from the revenues from the carbon tax. And I think, to me, this is when I look at the debate in the US and I see this lack of progress towards sort of getting political consensus around a carbon tax, it looks to me that there's a huge marketing or branding issue, which is, once something in the US is called a tax, it's very hard to get through. But the beauty of this tax is it raises a ton of revenue. Not only does it sort of, reduce a distortion in the economy, which is great from from an efficiency perspective, but you can actually use the money for a lot of things. And so, trying to push to think about the rebranding from a carbon tax towards a carbon dividend. Start talking about all the things that you can do with this extra money. One thing that you might want to do is reduce other distortive taxations, reduce income tax rates. You're getting a double benefit. You're getting less distortion from the carbon tax, and then you're getting less distortion by reducing marginal income tax rates and so on, or use it directly for this. And so this is a point that economists have been trying to make for a while. In the Wall Street Journal, 3 years ago, there was an op-ed by economists that says, look, a carbon tax is the most effective lever to reduce carbon emissions. But last point, to maximize the fairness and political viability, the revenue should be returned directly to US citizens through lump sum rebates. Most people would benefit from receiving these carbon dividends when it would benefit more than they pay in increased carbon taxes. This has received a lot of support from, a wide range of economists, across the political spectrum. And my sense is that, rethinking about what you do with the money that you raise and taking a little bit, a focus away from the fact that gas prices will go up. Yes, gas prices will go up, but if the government sends you a $3,000 check every year, for most households that would offset more than one-for-one the increases in that. So I think really, Diego's paper, really highlights why I think a carbon dividend framing of this Pigouvian taxation is the right way to go, because in the absence of that, if we just talk about the tax and we just talk about, the increase in the cost, you do have these undesirable distributional implications, and really highlighting that the flip side of the raised revenue you can use to mitigate those directly and actually make most people better off financially and increase efficiency seems to me the right way to go forward. So that's all I have to say. I think it's a really great paper, and I think the more you can do to help us sort of understand those magnitudes, I think the better it will be. Thank you.
Thanks very much, Johannes. And so, Diego, you have a couple of minutes to respond. And I would add to Johannes's recommendations, we think about ways not only to redistribute the carbon dividend, also ways maybe particularly for lower income households, to finance their investment in either housing or transportation that is less carbon intensive.
Fantastic. Yeah, no, thanks so much, Johannes, for this discussion. This was really awesome and very helpful. On the first point regarding the magnitudes, I agree, these magnitudes are large. Let me also emphasize here that there is also estimation and model uncertainty. So obviously this is suggestive, but I wouldn't like just pick this 0.75% dip in industrial production at face value, but I agree, like we have to understand what's driving this. In my paper, I've really focused on this demand channel, and I think this can go some way. There could be other amplification channels as well, for instance, on the supply side, for instance, complementarities between energy and capital, or the input-output structure, as emphasized by Bakai and VRI. But I think it's important to better understand that.
Can I just to follow on that, because I think that's really, you have that in the model. The question is, shouldn't you get the same effects from any increase in energy prices? And so what then happens when the energy price triples? Like, why doesn't the economy tank entirely?
I agree. So, and I did some exercise along that line. I think it really depends what's driving the energy price. Obviously, energy prices are also driven sometimes by demand shocks, and then we would expect a very different outcome on activity. But it's true, for instance, oil supply shocks, we would expect them to have similar effects. And in fact, that's also what I find using the same sausage machine. So in some sense, this seems to be general, but what you also say, we could also look at other shocks. So one thing that I still have to do is to look at monetary policy or fiscal shocks in Europe and see, okay, how do these indirect channels that I emphasize, what role do they play in the transmission of these shocks? But yeah, that's something that I still have to do. But I think that's an excellent point. And on the second part regarding the carbon dividends, I think again this is spot on. I think I can do more in that respect. It's one of the policy implications or the key policy implications of my work, but then going more into the specifics, how to do this would be super interesting. And also one aspect that I find interesting is because often in this literature, we assume, okay, we have these carbon revenues and these are going to be enough to offset all these distributional implications. But faced with these frictions, with the financial frictions, with MPC heterogeneity, the effects may be larger. So in fact, I think it would be interesting to study in this framework whether the carbon revenues generated by the policy could be maybe not enough to offset it in such a framework when you have these frictions. So that would be something that that's very interesting to explore further. Yeah.
Okay, well, thanks very much for that.